Some shocking reporting from the Wall Street Journal going all the way back to 1878, not 1978, 1878, looking at a 60-40 investment portfolio, 60% equity, 40% bond. They're telling us that the year 2022 is the fifth worst year on record over that extended period of time. And even more surprising than that, it's the first time that the bond portion of the portfolio has not helped or assisted in the overall returns. It's pretty shocking. We're going to dive deeper. Stay tuned.
Welcome to the Trending Report, brought to you by USA Financial. The Trending Report is a bi-weekly show that aims to focus on the trend lines rather than the headlines. Each episode features commentary around the state of the market, as well as other factors that may impact your personal finances. The host of the Trending Report is an investment advisor representative of and securities are offered through USA Financial Securities, member FINRA SIPC, a registered investment advisor. The Trending Report is educational and not intended as personal financial advice.
Hello and welcome once again to the Trending Report. Today we're going to be discussing data as it ended last Thanksgiving week, specifically on Friday, 11/25, as the market was open on Friday for a period of time, although it was closed for the Thanksgiving holiday. With that being said, we are going to discuss the impact that the Fed's tightening cycles on interest rates has been having. And if you recall from our last discussion, we talked about the fact that the idea was to cool down inflation, obviously, and in doing so, also cool down the job market. And it appeared that the job market was, in fact, being cooled down. And to a certain degree, there is some evidence to point at the fact that inflation started to cool down a little bit. But nonetheless, the perspective is quite interesting. You can go back over the last 3 decades, and what you'll find is that in 2022, we have had the fastest incline of Fed tightening, meaning Fed increasing the interest rates. You can see the incline taking place here versus going all the way back to 1994 and 95, or the dot-com bubble for 1999 to 2000. And then even in 2004 and 2006, although it was very lengthy, it was steady and at a slower incline or lower incline. And then 2016 to 18 was the lowest incline. So what's really interesting that we'd like to look at today is also what's been going on in the bond market, because with bonds, as we've discussed way back here on the Trend Report, as interest rates are declining, the underlying value of the bonds is increasing, and that generally is a good thing. And bonds have had a very good run for decades because we have been witnessing an interest rate declining environment, a reduction in interest rates taking place for an extended period of time, which was very good for the bond market. Now, also, however, when you hit zero, as we've done with the Feds prior to the pandemic, then the angst became, well, there's nowhere to go but up. And as interest rates rise, the opposite happens. The underlying value of the bonds would decrease. So with interest rates rising, we are seeing a little different environment. Now that impacts this, but what's really interesting is if you look at annual returns that did not perform well for a 60-40 portfolio. So a very generic, very passive, non-managed, just kind of run-of-the-mill 60-40 bond to equity portfolio, meaning 60% equities, 40% bonds. The Wall Street Journal went back all the way to 1878 and identified what took place with a 60-40 bond portfolio, stock to bond or equity to bond portfolio. And what we're looking at is this dark line right here. I'm just going to highlight it across the top. That dark line represents the 60-40 portfolio. And then the next line is the stock return. And then the next line is the bond return. So this is essentially the average of the 60-40. And then you can see what they did. Well, what's interesting here is when you look historically at bonds, they have been there to, in bad environments, taper the negative impact of the market onto the portfolio. So here you see bonds at a slight loss compared to the market at a large loss. And then you see a slight gain. And again, a slight loss here, a slight loss here. We see a gain here and a gain here. And these here to the end are all gains. And so they help to offset what was taking place in the equity market. However, in 2002, as we have pointed out here, you can see that all three lines are essentially equal. Therefore, the bond split or the bond diversification inside of a 60-40 portfolio did not do much to help in 2022. They all came in right here at about 15%. So in all of these worst case scenarios, the worst 10 years going all the way back to 1878, the 2022 market was the only time that the bonds did not, in fact, actually help the portfolio, because here they mitigated. So there was a loss, but it was less of a loss. Here we had a gain. Here we had, again, a loss and a loss. Here we had a gain. Here we had a significant gain, and then, again, some minor gains. But here we see the bonds coming in at a loss of minus 15% in that scenario. So the impact of interest rates on the bond market can be significant, and we're seeing that play out here in 2022. Now, when we look at how does this impact the overall? Well, now we're getting into the micro and the macro of the markets, again, the way we like to measure things. So if we're talking about capitalization, in the capitalization environment, and we look at macro, we're looking at the overall stock market is coming in here, and it will always come in somewhere in the middle because it's essentially an average, right? So half of the market or certain components of the market will be rising or will be helping to lift the market. Certain components will be dragging it down, and you get your average in the middle. So here what we're seeing from a macro standpoint is basically we're getting all mid caps in here. We're getting value in here. And then we're starting to pick up the small caps with value leading the charge there as well. And here you're seeing we're finally getting back to seeing some bulls in this range, meaning that both the macro and the micro are showing up as green. And then down here, as you can see, the macro is red, the micro is green. So what we're starting to see is the micro is starting to lift the macro as we stand today. Now, if we flip this and we run from top to bottom on the micro side, we still see the overall stock market relatively in the middle. We're still seeing mid-cap value here, but look what happens. We're starting to pick up larger cap, the S&P 500 value and the overall index, and also the 100 index are coming in at the top. We're not seeing the significant trending together or congealing of the mid caps and the small caps as we were in the macro. Now, if we come over here to sectors, again, there are 11 sectors making up the S&P 500, and then we throw in the overall stock market itself. Again, the overall stock market, essentially, we're going to have roughly half of the market lifting, roughly half of the market dragging it back down. So here we're seeing energy, industrials, financials, healthcare, consumer staples, and materials at the top. But then over here, we're seeing energy at the bottom on the micro. We're seeing the financials coming down to the bottom on the micro. So the change is a little different, but we are seeing that bull ranking, meaning that these are all green. Both of them are green, and here you'll notice they are red on macro, green on micro. So again, that tells us that the micro trend is lifting over the macro right now. In fact, if you come down over here to the other side and you look all the way down the line, we've got green, meaning positive trending numerics on everything in the micro column. Energy is coming in very close to the bottom at 2.9, or very close to zero, I should say, at 2.9. But on the macro, it's the highest. So we're seeing this go from the very top to the very bottom, which tells us that things may be flipping in terms of what sectors are driving the market. And then finally, if we look at the bond environment, we can take a similar approach, but here we use the BND ETF, which is a total bond market. And we've got Short term, basically short term and some high yield, all in here. And the difference is on when we go to the micro side, we're seeing the long term stuff. So when we come on the macro, we're seeing short, intermediate, 1 to 3 years is short, 3 to 7 relatively short. And over here, we're seeing long term, 20 plus years, 10 to 20 years, intermediate, and so on. So again, kind of a flipping of the stages. But here we have no bull, no bear. Everything is running negative on the macro, positive on the micro. We're seeing that obviously in both instances. So then if we take a high altitude view overall, here, this is the total stock market, the ITOT ETF. As of middle of January, right in here, we're seeing the macro trend goes red, which makes sense when you're seeing what's going on in the overall trend of the market. But right here in the micro, we're seeing that popping positive as of the middle of October, which again makes sense because that is representative of this micro increase. So we don't know if that is just a short-term bounce or if it's going to actually turn the tide and have the macro start to move back to the positive. On the bond side of things, we are seeing relatively similar. We've got red for the entire 1-year graphic here. Definitely a downtrend, and we're seeing a pop or a bounce right here with the green, and again, that's representative of this little upstretch right in here. So, interestingly, from a very high altitude view, the stock market and the bond market are looking somewhat similar right now, which is why we're seeing what we saw on the chart before. We're not getting the opposite effect here. We're not getting where the equities are down and the bonds are up and vice versa. There's no teeter-tottering effect taking place here. They're both working their way in a downward macro slope. Hope that's helpful. Look forward to talking to you again soon.
Thanks again for listening to this episode of The Trending Report, powered by USA Financial. We invite you to visit usafinancial.com to find out more about our work with independent advisors and their clients all around the country. Any projections, targets, or estimates in this report are forward-looking statements and are based on the firm's research, analysis, and assumptions. Due to the rapidly changing market conditions and the complexity of investment decisions, supplemental information and other sources may be required to make informed investment decisions. All expressions of opinions are subject to change without notice. Clients should seek financial advice regarding the appropriateness of investing in any security or investment strategy discussed.